Hey guys, how you doing? Hope you're well. In this video, we're going to talk about what the smart money, what the so-called smart money is doing right now. In fact, you won't believe when I show you this chart you see over here, and what this is likely telling us about the actions of the smart money. Join me. Hey guys, welcome back. And before we begin and talk about the charts, let me just tell you where I am. This stretch of wall you see behind me is a very famous wall you might have heard of called Hadrians Wall. I'm actually in northern England, close to the border of Scotland, as a matter of fact. And this wall was built in the year 122 AD. Yes, guys, you heard it correctly. It was built in the 2nd century by the Roman Emperor Hadrian, and they date this wall to the year 122 AD, or 122 CE, essentially. All right, guys, so why don't we just take a walk by Hadrian's Wall, and we can talk about the charts and the major markets. So in this video, I'm going to show you this chart. It's an absolutely crazy and insane chart. When I show you what it potentially means, it has a major warning, in fact, for the major markets. All right, guys, by the way, let me just tell you, as I'm walking, it's quite steep here. I don't know if you can see this, but it's a very steep downward decline. But fortunately, not too many visitors here today, so we can have a nice quiet chat here as I'm walking. All right, guys, now about the markets. There was an interesting piece in the Wall Street Journal very recently, very interesting article, which I want to read for you here. And when I first read this, I got to tell you, I actually laughed pretty hard. So let me just tell you what this article says. According to the Wall Street Journal, and here's what they say: hedge funds, walloped by the meteoric rise of stocks such as GameStop and AMC in January, are still struggling to get out from under those losses. And also it says that some hedge funds, like Melvin Capital, which lost more than $6 billion in January, is now down 46% through June. The Wall Street Journal also says another hedge fund by the name of Maple Plain Capital is down 39% for the period. So if you've been following the news, I think you can pretty much guess what this is all about. It's about the fact that some months ago, back in January, you may recall, certain stocks like GameStop and AMC, they skyrocketed, they started rallying really hard, and the rally in these particular stocks have hurt some hedge funds. Okay, so look, these hedge funds, as I'm sure you know, were shorting these stocks. They were betting against these stocks. So when GameStop and AMC started going up higher, they essentially called massive losses to these hedge funds. Again, as the article in the journal said, these hedge funds are down between 39% to 46%. Quite a massive loss for the year. By the way, guys, I don't know about you, but I think now might be a good time to do a moment of silence for the poor hedge funds. All right, guys, let's continue. There's something also interesting in this article I want to read to you before we look at the chart. It says over here that client notes from both Morgan Stanley and Goldman Sachs showed that fundamental stock-picking hedge funds posted negative alpha trader, which means a shorthand for poor performance in the first half of the year. What's the reason? Well, according to the journal, the challenge for professional stock pickers is that markets have been heavily rotational, according to several fund managers. And they say that markets this year have whipped back and forth between growth stocks and value stocks, making it difficult for managers to find winning trades. So guys, this goes to show what I've been saying to you in my previous videos. A lot of folks out there, a lot of people think that hedge funds are the smart money. Guys, you don't believe me? Go and ask anyone you know. Ask your friends, ask family. As soon as you mention the word hedge fund to most people, they think, oh, these are the smart money. These are the pros. These are the guys who know what they're talking about. But actually, guys, as the Wall Street Journal correctly says, these guys, these hedge funds, regularly underperform the market. In fact, most of the time, they're making losses. So let's go back to what I was talking about. Essentially, what's happening is that hedge funds this year so far have underperformed the market, the major stock markets like the S&P and the Dow. And again, it's not surprising. In fact, according to an article that was published some years ago, I think it was Bloomberg or Harvard Business that published this article, they said that hedge funds do usually underperform the markets. It's actually quite normal. So this big status and hype about hedge funds being the smart money is actually complete nonsense. It's not really true. Most hedge funds are not the smart money as everyone thinks they are. They're actually the dumb money. So here's what we can learn from this. According to a recent newsletter from Jason Gephert, in fact, Jason published this very recently, he said that hedge funds are now getting into the stock market in droves. In fact, what these hedge funds are doing is absolutely insane. They are now piling into the stock market. They're buying into the stock market with leverage. In other words, they're borrowing money to buy stocks. And here's the interesting point. Whenever this has happened in the past, whenever hedge funds have drove into the stock market, have piled into the stock market, This has been a contrary indicator, a very good contrary indication. In fact, as you can see from this chart from Jason Geppert, he says that the latest estimate of hedge fund exposure shows that funds are nearly 40% net long stocks, a quick rise from almost being flat a month ago. So about a month ago, they had no positions in the stock market. Just very recently, they've entered the stock market with leverage. And Jason says, over the past few years, when it has climbed this high, in other words, whenever hedge fund exposure has been this high, the S&P ended up giving any further gains back. As you can see from this chart, in fact, hedge fund exposure is very close to being 40%, when it was almost flat just about a month ago. And Jason also says in the same newsletter that usually this is a contrary indication, that whenever hedge funds get so bullish, whenever they enter the stock market with leverage, like they're doing right now, that's usually a contrary indication. It's a major warning to the stock market that this so-called smart money, again, it's the dumb money really, when these guys are entering the market with leverage, usually very soon afterwards, the markets start to decline and go down. So in other words, in the short term, potentially in the next few weeks and months, it's likely the markets could experience volatility and potentially go down. And usually when something like this happens, the markets usually experience weakness and they experience a decline. The short-term expectation for the markets within the next few weeks and months is not very good. So guys, this means the action of the hedge funds is a likely warning, a major warning to the stock markets. All right, guys, hope this video helps. Let's walk back now to Hadrian's Wall. Let me show it to you one last time before we leave this amazing place. Again, when you think about it, guys, that this wall was built in the year 122 AD. I mean, it's just a fascinating piece of history. And again, the Emperor Hadrian is one emperor I don't know much about. I don't know if you guys have studied the Emperor Hadrian. I have not. But again, this is just a fascinating piece of, I guess, of Roman architecture. Imagine this being built by the Romans almost 1,900 years ago. All right, guys, so from Hadrian's Wall in the north of England, I wish you a fantastic day. Hope to see you guys soon. Cheers, guys. Bye now.